Okay, let's continue. In this video lesson, we'll talk about different types of exchange rate fluctuations. As I've mentioned already, what matters is not the exchange rate itself, it's not the number, which means how many units of a specific currency we can purchase for £1. What matters is the fluctuation in the value of the pound. In other words, whether it goes up or down. Exchange rate fluctuates on daily basis, and they do fluctuate for various reasons, as we've covered already, but what matters for us is that there are different terms which can describe different types of fluctuations. The first term which we need to use is appreciation of the exchange rate. This is the situation when a particular currency raises against other currencies. So, for example, pound becomes stronger. This means that each pound will purchase more of any other currency. For example, previously the value of the pound was equal to $1.50, and then a pound appreciated, and now it can purchase $1.6 per each pound. So appreciation of the exchange rate means an increase in the value of a particular currency. It will have an important effect on the balance of payments. Strangely enough, a strong currency is bad for the balance of payments, and it's actually bad for the aggregate demand. Why is that? The thing is, when a particular currency appreciates, it will have a negative effect on the trade balance of this particular country. Let's have a look how it will work. So first of all, when a pound becomes more expensive in terms of other currencies, it means that our exports will become more expensive for foreigners to buy. When £1 purchases more of any other currency, it means that foreigners which want to purchase our products will need to pay higher amount in their domestic currency units to purchase an equivalent value in pound terms. For example, if you used to export an item which cost £100, previously Americans used to pay $150 for this product. Now they will have to pay more. They will have to pay $160, which means that a rise in the value of the pound, appreciation of our exchange rate, will make our exports more expensive for foreigners, which means that demand for exports will drop, and this will lead to a reduction in the exports within our aggregate demand equation, within this term for net exports which we used to have. So let's add this. Aggregate demand, as you remember, is a sum of consumption plus investment plus government expenditure plus net exports. And net exports is the difference between exports and imports. When currency appreciates, it will lead to a reduction in exports. Negative effect on exports. Strong currency makes our exports less competitive in international markets. On another hand, it will also lead to an increase in imports. Why is that? Because when our currency can purchase lots of foreign currency, when our currency appreciates, when pound becomes stronger, it means that foreign products will appear to be cheaper for British consumers. It will mean that we will need to spend less in pound terms to pay an equivalent amount in terms of other currency. So imports will become relatively more attractive, which will lead to an increase in the demand for imports. And as a result, there will be another effect which will affect the net exports of the country. Exports will drop, our products will be less competitive in international markets, while imports will increase. So it will have a double effect on the net exports, which will lead to a reduction in net exports, which will imply that we have a leakage from the circular flow, which will reduce aggregate demand. So that is why, strangely enough, a strong pound is not good for international trade. It would be better for us to have a weaker currency in order to be able to sell more to foreigners and in order to balance our balance of payments. Next, depreciation of the exchange rate is the opposite movement. It's a situation when a particular currency loses its value against other currencies. So a pound, for example, becomes weaker. This means that each pound will now buy less of a foreign currency. So if previously we used to be able to purchase, let's say, €1.50 for each pound, now we'll only be able to purchase €1.2 per each pound. You are buying less of foreign currency per each pound. This is what we call depreciation of the exchange rate, a fall in its value. This will have an opposite effect on the balance of payments, and weaker pound will have to improve the balance of payments. Why is that? Because weak pound will make our exports appear cheaper to foreigners, which will lead to higher demand for exports. When foreigners will need to pay less in euros, for example, per each £1 worth of items, they used to pay 1.5, now they only need to pay 1.2. In other words, a particular product which we are selling to them will appear cheaper, which means that our exports will become much more attractive for them. It's cheaper to buy our products now because of the exchange rate factor, which will increase demand for our exports. So exports as a component of the trade balance, balance of payments, as a part of aggregate demand will go up. And similarly, imports will appear more expensive for our domestic consumers because each pound will now only be able to purchase less in terms of a foreign currency, which means that if you want to buy a specific product, you will need to pay more in pound terms, which means that these imported products will now be more expensive for you to purchase, which will reduce demand for imports. And as previously, this will lead to another second effect on the net trade, on the net export, and it will help us to improve our balance of payments. Exports will go up, imports will drop, which will increase the whole term in brackets. And similarly, if you recall the formula for aggregate demand, consumption plus investment plus government expenditure plus net exports, which is exactly the difference between exports and imports. Net exports will go up, which will lead to higher aggregate demand and higher output level. So strangely enough, weak pound, weaker currency can be good for the country because it improves trade balance, it increases aggregate demand, which can help to support production level, output level in the country. And this is one of the reasons why sometimes countries decide to devalue their currency deliberately. They do not intend to maintain the value of the currency at the high level because they don't want to make their products less competitive in foreign markets. They want to do the opposite. For example, China frequently does this. They deliberately devalue the value of their currency, yuans, in order to stimulate their exports, in order to be able to sell more in foreign markets. And specific devaluation, deliberate devaluation of the exchange rate will represent one of the forms of economic policy, which we will discuss in a minute. Now, let's represent all these ideas in a graph. Let's imagine that we are talking here about the price of a pound in terms of dollars. So along vertical axis, we will have the exchange rate of a pound against the dollar. Along horizontal axis, we will have quantity of pounds. Demand for pounds will represent demand by American citizens who want to purchase our products. And supply will be provided by British residents who want to sell pounds for their own purposes. And as a result, of course, interaction between demand and supply will determine equilibrium exchange rate. If initially we start at the exchange rate which is not equilibrium, so for example, if the original value of a pound is equal to $1.4, and if at this particular exchange rate there will be a gap between demand and supply, in this particular situation, we will experience excess supply of pounds shown by point A compared to available demand for pounds. And this excess supply of pounds will lead to a depreciation, in other words, a decline in the value of the pound. And this depreciation will take place until equilibrium will be established at this point where value of the pound is equal to $1.3. In other words, where demand for pounds by Americans is just equal to available supply by British residents. So this is the blue dot where exchange rate is equal to $1.3 per each pound. If, however, we start from a different situation when the original exchange rate is below the equilibrium, shown by this green line, we will again experience a gap, the discrepancy between quantity demanded and quantity supplied. And in this case, we will experience a shortage of pounds because there will be a lower amount of pounds available on the market, shown by point D, compared to available demand for it. And as a result, this shortage of pounds will lead to increase in the value of the pound, in other words, appreciation. And these price forces, these movements in exchange rates will allow equilibrium to establish in the market. So this is exactly how equilibrium can be established. And on this graph, we can have a list of factors which can lead to a depreciation of the pound. We have covered which factors can cause these fluctuations in exchange rates in the previous video lesson. So let's summarize what events can cause this particular shift in demand and supply curves. For example, when we experience high inflation in the UK compared to inflation abroad, when we have a rise in the UK income, for example, when our citizens become richer, they are able to purchase more products, they want to buy more items, which means that consumption level will increase and there will be higher demand for both domestic products and imported products. And of course, if we want to purchase more products, this will increase demand for foreign currency, which will lead to extra supply of pounds. We want to get rid of our pounds to purchase other items which we want from abroad, and this will lead to shift in the supply curve for pounds. Fall in the British interest rates will lead to capital flows away from the UK. Capital owners will want to get rid of British assets. They will want to sell British assets and then exchange their pounds, which they receive for selling their items, and want to purchase some other currencies. So as a result, British currency will be in less demand compared to other currencies. This will lead to a reduction in the value of the pound against other currencies and the fall in the exchange rate. And so on. If relative investment prospects will improve abroad, this will lead to capital outflow from the UK and into these other better countries, again, which will affect the demand and supply of currencies. Or if there will be speculation that the rate will fall, people will want to get rid of their pounds before this happens, while the value is still high, which will lead to immediate increase in supply on the market and reduction in the value of the pound. This is an example of how you can use a simple demand and supply diagram to predict the effect of various macroeconomic events onto the exchange rates and forecast their movements, their fluctuations, appreciation and depreciation of the value of the pound. Next thing you need to know is that appreciation and depreciation of the exchange rates are fluctuations which are caused by market forces. However, the government and central bank, main policymakers, can also affect the value of the currency using their own instruments. And when changes in the exchange rates are caused by their deliberate actions, by their interventions, we use different terms. In this case, we will use the term devaluation and revaluation of the currency. So devaluation is the situation when the government or central bank deliberately reduces the value of the pound, of their own currency, in relation to other currencies. And revaluation is the situation when the value of the currency is increased by deliberate forces of policymakers. So appreciation and depreciation are movements in exchange rates which are caused by market forces, while devaluation and revaluation are the same changes in the exchange rates which are, however, caused by deliberate policy changes by central bank and in the government. The result of devaluation and revaluation, the effect on balance of payments, on trade balance, on aggregate demand will be absolutely the same as depreciation and appreciation respectively. So, for example, when the government devalues the currency, reduces its value, the trade balance will improve. However, when the exchange rate becomes more expensive due to deliberate revaluation of the currency, it will have the same effect as currency appreciation. It will worsen the trade balance. However, if we definitely know that trade balance improves only when the currency becomes weaker, if we allow it to drop in value, or when we devalue it deliberately, why don't we always do this? Because obviously better trade balance, better effect on aggregate demand would be beneficial for the economy. So why would we ever need to increase the value of the currency and worsen our trade balance? This is because the value of the currency is linked to the financial stability of the whole economy. It has a direct effect on the price level and inflation. Weaker currency frequently leads to inflation in the economy. When pound cannot buy lots of foreign products, it means that foreign imported products become expensive, which increases the inflation level in a country. And that is why sometimes, in order to combat inflation, in order to control inflation, bring it under control, we'll need to deliberately revalue the currency, increase its value to ensure that the price level does not increase too much. So as previously, as we've mentioned many times already during this module, there will be some trade-off between different macroeconomic policy objectives. By devaluing your currency, you achieve an objective of trade balance changes. However, you cannot control inflation in this way. And if you want to control inflation by increasing the value of the currency, this will lead to deterioration in the trade balance. You always need to bear this trade-off in mind.